Hello, everyone. In this video, we are going to discuss allocating resources across business units or the strategic business units that we discussed in the previous video. Companies need to decide how to invest in different parts of their business. Of course, they have a finite amount of resources and they need to make the strategic decision of how to adequately allocate these resources across their SBUs. So we will look at two key tools used for this purpose, the BCG matrix and the GE McKinsey matrix. Now these models, they help companies evaluate their SBUs and prioritize which SBU deserves the resources, and basically it helps them prioritize where to invest for maximum growth and profitability. The BCG matrix is a tool that helps companies decide how to allocate resources across SBUs. So, as you can see on the screen, we have a 2 by 2 grid, and that is known as the BCG matrix or the Boston Consulting Group matrix. Now, the BCG matrix plots each business unit of the company on this grid based on two dimensions. These two dimensions are market growth rate and the relative market share. So each quadrant represents a different type of business. So there are four quadrants. We have the first one is stars. So if an SBU is placed under the star quadrant, then this means that this is an SBU that is considered to be a leader in a high growth market. And because it is a leader and it has a big market share, then it also requires a significant investment to maintain its market position. Okay. The next one is cash cows. These are established business units with a large market share, but they are located in a low growth market. Okay. So the market or the industry that they are in, there's not really much growth happening there. So cash cows, they generate steady profits with little need for further investment, again, because the market that they exist in is characterized by low growth. The next quadrant is question marks. So these are business units with low market share, but they exist in high growth markets. So companies must decide whether to invest in them in order to turn them into stars, or they can avoid investment and just choose to sell them off or completely discontinue that unit. And the last quadrant is known as the dogs. So, dogs are SBUs with low market share and they also exist in a low growth market. So, basically, they are not worth investing in further. Companies use this matrix, the BCG matrix, to prioritize resource allocation and ensure that cash cows, for example, continue generating profit. Stars can maintain their leadership in a high growth market, and question marks are carefully evaluated for future investment. The next tool is the GE McKinsey matrix. So, the GE McKinsey matrix is another tool used to evaluate and allocate resources across SBUs as well. And this matrix uses two dimensions, the industry attractiveness and the business unit strength. So each business unit is positioned based on these criteria, much like the BCG matrix. And the tool helps companies decide which units to invest in, grow, or phase out. However, unlike the BCG matrix, which only looks at market growth and market share, the GE McKinsey matrix takes a more holistic view. Okay. It considers other factors like the market size, profitability, and competition when evaluating SBUs. This broader evaluation provides companies with a more comprehensive understanding of their business unit's potential. It uses two main things to assess the industry attractiveness, which refers to market size, uh, growth rate, competition, and how much profit companies in that industry are making. Then we also have competitive strength, which is the company's strength when it is compared to other companies or rivals. So, factors like market share, profitability, customer loyalty, and brand strength are also evaluated. Now, once you measure these factors, each business unit is placed on a 3 by 3 grid, showing if the company should invest or grow, it should select or hold, or divest or harvest. If the unit is in a highly attractive industry and has strong competition, you might want to naturally invest more. But if it is in a low attractiveness industry with weak competition, a company may want to sell it off or reduce investments.